In this video, we're going to take a look at residual income. So residual income is a performance measure just like ROI is, but it is a separate calculation. So sometimes managers will be evaluated on ROI versus residual income or vice versa, or sometimes a combination of both. So residual income, it's basically the amount of income that was generated over and above the minimum required return on operating assets. So you just take your net operating income for the period, and then you subtract from that the minimum that was required given the company's average operating assets. So to illustrate, it says the retail division of Zephyr Incorporated has average operating assets of $100,000 and is required to earn a return of 20% on these assets. In the current period, the division earns $30,000. So to find our residual income, we're going to start with the actual net operating income for the period of $30,000, and from that we will subtract what the minimum required net operating income is based on this minimum return of 20% and based on the average operating assets of $100,000. So we're going to take the $100,000 of operating assets and multiply that by 20%. So here we get 30,000 minus 20,000, and that leaves us with $10,000 of residual income. So here we ended up generating $10,000 more than the minimum that was required based on the amount of assets, the amount of productive assets that the company has. So here the residual income is $10,000. So let's try that again with another example. So we have Redmond Awnings, a division of Wrap-Up Corp, has a net operating income of $60,000 and average operating assets of $300,000. The required rate of return for the company is 15%. What is their residual income? Okay, so for residual income, we start with the actual net operating income. In this case, it's $60,000. And from that, we're going to subtract the minimum required return. So the average operating assets is $300,000, and at minimum it's required that 15% be earned on those productive assets. So we're going to take $60,000 here and subtract from that 15% of $300,000. So we'll do 15% times $300,000, and that gives us $45,000. And that leaves us with a $15,000 residual income figure in this case here. So in this case, we ended up generating $15,000 more than the minimum requirement based on the amount of productive assets that Redmond Awnings has. All right, so let's take this a step further. If the manager of the Redmond Awnings division is evaluated based on residual income, will she want to make an investment of $100,000? That would generate additional net operating income of $18,000 per year. So we're saying if the division manager is evaluated based on residual income, will she say yes or no to this investment? So the first thing we'd want to do is figure out what is the new residual income after investing in this project. So we would have to first see what the new net operating income is. So before, the net operating income was $60,000, but they're saying that it's estimated that this investment will add, let's see, additional net operating income of $18,000. So that will provide us with $78,000 in net operating income post-investment. But then that's not the only thing that changes. There's also a change in our average operating assets. So the average operating assets prior to this was sitting at $300,000 from our prior problem there. But now we're investing in $100,000 in additional assets here. So that brings our average operating assets up to $400,000 there. So that's our new figure there. So now we just recalculate our residual income. So what would be our residual income? So in this case, they're saying we would have net operating income of $78,000, and that would be the minimum required return on those assets. Well, our average operating assets will then be $400, not $300 anymore, and it's required to earn a return of 15% at minimum on any productive assets. So let's first find out what 15% is of 400,000. That's 60,000. So we'll have to compare the net operating income after investment to that minimum net operating income of $60,000. So we can see here that investing in this project would lead to an $18,000 residual income for the division as a whole. Now, would the manager accept or reject this investment opportunity? Well, we have to compare the residual income after investment to the residual income before the investment. And what is the residual income before the investment? Well, we just did that up here, right? The residual income before the investment, we calculated it out to be $15,000. Well, after investing in the project, it's estimated that that residual income will increase from $15,000 to $18,000. So that represents a $3,000 increase in residual income. So if this manager is being evaluated based on residual income, she's going to want to say yes after crunching these numbers, right? Because it's estimated that this investment will cause her division's residual income to go from $15,000 to $18,000, and that will look good when it comes to evaluating that manager and the operating results and investment results of this division. So this is a couple of examples of how not only you can calculate residual income, but how you can use it as a manager to help make investment decisions.